This week on WealthTrack, a financial thought leader who spotted the storm clouds of the credit and housing bubbles early on. Gluskin Sheff's chief economist and strategist, David Rosenberg, on the storms he still sees ahead and where investors can seek shelter. Next on Consuelo Mack, WealthTrack.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack WealthTrack before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to WealthTrack Premium subscribers. If you're interested, just go to WealthTrack.com for more information. Thank you. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. Are we in a depression? That is the question being raised by this week's financial thought leader guest. In a recent special report titled Not Your Father's Cycle, but Maybe Your Grandfather's Great-Grandfather, economist David Rosenberg notes that an economic depression occurs only once it becomes painfully obvious that the markets and the economy are failing to respond to repeated bouts of policy stimulus. Well, how are we doing after 3 years of repeated and in some cases record amounts of fiscal and monetary stimulus? Not great. As Rosenberg points out, no major economic indicator from employment to GDP to industrial production to real incomes has managed to get back to their prior cycle highs in late 2007. Those are the unfortunate facts, as are some other indicators Rosenberg is tracking, including home sales, which are much lower than they were in late 2009, the S&P 500, which is at the same level it was more than a decade ago, and 10 years' worth of zero employment growth. Now, the vast majority of economists disagree with Rosenberg's dire assessment, but increasing numbers of them, including those at the Federal Reserve, are lowering their forecasts and predicting several more years of slow economic growth, low interest rates, and uncomfortably high unemployment. In other words, the world is just starting to catch up to Rosenberg's long-time predictions. David Rosenberg is the chief economist and strategist of Toronto-based investment firm Gluskin Sheff. For years, Rosenberg was the influential chief North American economist at Merrill Lynch, where Institutional Investor magazine placed him on their coveted All-American All-Star team from 2005 to 2008. His daily Breakfast with Dave report is a must-read among his many fans. Now, Rosenberg is known for being years ahead of the pack in spotting the housing and credit bubbles and predicting the serious and prolonged damage they would inflict on the U.S. and world economy and markets. But a depression? Well, I asked him why he is using the D word.
Well, I'm using the D word because the R word, which is the recession, generally applies to a contraction in the economy in the context of a expansion in credit, which is what we've been accustomed to for the better part of the past 50 years. What we're seeing right now is something different, and we actually are not in a period of GDP contraction right now, but we're still in the throes of what I would say a modern day depression, much like Japan, and that what we're seeing is a secular contraction of credit, especially as it pertains to the household sector. So when you take a look at other variables, like for example, how often in our lives have we gone through a 10-year period with no employment growth? Employment in the United States is the same today as it was 10 years ago. What about the stock market? I mean, there's been peaks and valleys, but it's no higher today than it was 12 years ago, referring to the S&P 500. But I think in the final analysis, we have to sit back and contemplate, what does it mean when the yield on the 3-month Treasury bill is 1 basis point? All right, like 1 basis point. And when you have short-term interest rates close to zero, the money market is telling you something about what the economic outlook is, and it's extremely fragile. And it doesn't mean that we're going to continuously backslide into recession. It just means we're in this elongated multi-year period of very weak economic growth coming off the credit bubble that burst 4 years ago.
So how elongated is it going to be, do you think?
Well, most academic pieces of work have shown that when you go through these deleveraging cycles, they can last 7 to 10 years.
So we're 4 years in.
Right.
And, some of your people in your profession, other economists, for instance, the Fed chairman, Ben Bernanke, recently said that they've seen some signs of life in the economy. What's your analysis of these green shoots that we're seeing?
Well, I don't think that the green shoots are universal. Normally, for this stage of the cycle, going into the third year of an economic expansion, the numbers are 5%, not 2.5%. But 2.5% is certainly better than what we've seen over the course of the past couple of quarters. But if I'm not mistaken, this time last year, most economists were looking at roughly 4% GDP growth this year. And here we're talking, third quarter was 2.5%.
And they're happy about it.
And they're happy about it. Well, people have adjusted their expectations, but 2.5% is actually soft growth in the context of where we are in the cycle. Secondarily, when you average out the year so far, because you can always just look at one data point, one particular quarter, one particular month, but when you average out the year, we're barely above 1% on GDP growth. The unemployment rate is still stuck over 9%. And what was important, I think, wasn't so much about Ben Bernanke talking about what's already happened, that the third quarter was moderately better than expected, which was true. It was when he said that, that the outlook has considerable downside risks. The Bank Canada recently said something very similar. Well, what do you know? The ECB cut interest rates unexpectedly. And what does it say? That the downside risks to the outlook are considerable.
But let me ask you about corporate profits, because I think the third quarter corporate profits, it looks like they're going to be up about 17.8%. And again, the people who are trying to be constructive about the economy and the outlook are saying, you've heard this argument many times before, and what's wrong with it, and the argument is that corporate balance sheets have never been stronger, that in fact, that corporate profits are still coming in, double digits. So therefore, that corporate America is healthy, and it's just that consumers deleveraging, and that's a good sign, and that, that the government is going to be forced to get its act together. So that's a good sign too.
Right.
What's wrong with the strong corporate profit scenario? I mean, what's that theory that in fact the stock market should be doing better than it is?
Well, I agree, by the way, that corporate balance sheets are in great shape.
Right.
But you see, the stock market inevitably is going to be priced off of earnings. Corporate bonds will be hitched to the balance sheets. And insofar as the third quarter earnings, you're right, double-digit growth. A lot of that is still reflecting, we're talking about year-on-year growth in the third quarter. So by definition, looking at year-on-year growth, looking at where we were vis-a-vis 12 months ago, we're just talking about what's happening in the here and now. So we can drive and just gaze through the rearview mirror. But for our clients, what we try and do is look through the windshield.
Right.
And so what made this quarter different is the guidance. The guidance was much more mixed, shall we say, to negative than any other time in the past 2 years during this recovery phase. I would also say, the earnings came in fine, but a lot of the earnings, a lot of the juice came from, one-time accounting shifts in the banking industry, drawdown of reserves, stuff like that I would call non-recurring. It was actually, if you take a look, there were some bright spots, especially in the capital goods industry, and capital spending is one part of the economy that's
right.
actually doing quite well. But it was rather mixed across sectors. But the guidance, I think, is what made this particularly different.
From the CFOs and the CEOs, they're not optimistic about the future.
They don't have the visibility they had 12 or 24 months ago. That's the difference.
So what's your outlook for the U.S. economy? And I'm looking at the foundation of the health of the U.S. economy is employment. What's your assessment?
Well, I think that we're probably going to find employment slowing down. It could even start contracting in the opening months of next year. It wouldn't surprise me when you're taking a look at all the layoff announcements that have taken place. And keep in mind that although employment's been growing, it's still been, when you're talking about, say, numbers close to 100,000, that's basically, 0.1% increase.
Right.
I mean, it's better than slipping backwards. The jobless claim numbers right now aren't pointing towards a contraction, but when you take a look at the layoff announcements, they lead the jobless claims, they lead employment, and my sense is that it's going to be another very tough year as far as job creation is concerned. We have faced, I'm talking about we, not just in the United States, but globally, just faced a very significant financial shock coming out of Europe at a time when we had a relatively flat economy. And the financial economy and the real economy, there's a symbiotic relationship, but the financial economy, or what you might call Wall Street, leads the real economy, what you might call Main Street, by anywhere from 3 to 9 months. You know, it was no different when the tech wreck started, say in the opening months of 2000. It didn't start to really hit the real economy until we were in the opening months of 2001. And the last cycle, all the bad stuff happening with the mortgage market was starting really in the opening months of 2007. I remember New Century Financial closing its door, one of the largest subprime lenders. Didn't start to hit the real economy until December of 2007. So we're in a situation today where everybody, it's so fast money. If something happens on a Monday and you don't see it impact anything on the Wednesday, well, it's not going to happen. But you see, there are long and insidious lags between what happens in the financial economy, the impact on the real economy. But you see, we went into this situation with the economy roughly flat, and we got hit with a very major financial shock and tremendous volatility. And that's going to come back, I think, with a lag. And I expect we're going to start to see more evidence of this in the opening months of 2012, that we're going to start to see the economy potentially start to contract at that point.
So is MF Global, for instance, the bankruptcy of MF Global, is that kind of the canary in the coal mine? I mean, is that a harbinger for more troubles to come, both in the financial sector and also on Main Street, as you said, in the main economy?
I would put it exactly you just did. I would just take out the question mark, because I think it's actually more of a statement than a question. So I do think it's a canary in the coal mine. And I'm wondering whether, say, 6 or 12 months from now, we'll be looking back at what happened with MF Global. Was that the Bear Stearns of 2011? And I remember people thought after Bear Stearns it was all going to stay contained, and the Fed orchestrated this deal with JP Morgan, and who even knew back then we were already into a recession, and then who knew that there's going to be more legs along the way. You see, the one thing about a financial crisis like this is that, there's never just one cockroach in the messy kitchen. There's usually a few of them. So I would tend to agree with that. This is actually the one element that you can point to as to how the situation in Europe has come back into the United States in a tangible way. Okay, not just how it affects the stock market, volatility, but actually this was the 8th largest bankruptcy in U.S. history.
Which is kind of being lost in the news coverage.
5th largest financial. It's...
Right.
Right. Well, but it stays contained and complacent until it doesn't anymore. And that was the situation back in 2008. It wasn't a straight line down. I remember in the opening months of 2008 when there was bouts of euphoria. People thought it was over after Bear Stearns and the stock market. But I remember that we had the Bush tax cuts and the stock market rallied. And nothing's going to move in a straight line. But what's happening in Europe right now and the global ramifications, I think, are very significant.
So let's talk about that, because one of the things is that this deleveraging that is occurring is a global phenomenon, and the deleveraging is happening very, very starkly and severely in Europe. So what's your assessment today of what's happening in Europe and what the impact is, the long-term impact on the economy and markets?
When you think about it, how many monetary unions have ever worked? I mean, you go back over a century. There was the East African Monetary Union. You had the Scandinavian Monetary Union. You had the East African Monetary Union. Nobody knows about these monetary unions. You know why? Because they don't exist anymore. The only monetary union that works is the United States. Well, because we have a central regulatory, central fiscal, central political union.
And we fought a civil war to get it.
Well, that's exactly right. Well, before that, we had Confederate money, and
exactly.
But as it stands now, the United States, look at everybody's got their blemishes, but I think in the final analysis, it's going to have to be up to the European Central Bank. Is going to have to probably radically change its mandate. Look, they just cut interest rates with inflation at roughly 3%, well above their target, because now they're focusing on growth. Well, that's the Fed's mandate. That's not the ECB's mandate that modeled itself out of the bund. So we have a new head of the ECB. He's willing, I think, at this point to be a lot more flexible.
Right, Mario Draghi. Mm-hmm.
That's right. Than
not the rigid
Trichet.
Mm-hmm.
And maybe the mandates are going to have to change at some point. I think that the ECB's balance sheet, in terms of, and we're talking quantitative easing, money printing, they're going to have to play a much larger role in the lender of last resort. And we're not talking about just for the traditional banking sector, but for governments. So I think in final analysis, this will end up at Germany's door. Will we go finally towards a Euro bond, which will have to be hitched to Germany's credit rating, assuming it's still AAA by then. But I think that the ECB is going to have to play a much larger role. And that's why, and this is David Rosenberg being optimistic, maybe this was a good time to have a change in leadership at the European Central Bank.
If it ends up in Germany's door, what do you think will happen?
Well, that's a great unknown. That's a great unknown. I think that this actually gives Germany a great opportunity to really reshape the whole Eurozone and have more control. It may well be that we finish this book and the Eurozone, as we currently see it, as a bunch of the northern stronger countries, and that the southern Club Med countries, who maybe in retrospect never should have been allowed into the zone, maybe they go back to their own currencies. But it wouldn't surprise me that when we come out of this, the Eurozone itself is going to be smaller than what we're seeing right now.
Markets. Let me ask you, because you had just mentioned that the fact that you're watching the bond markets.
Well, I usually find that the bond market, that's where the truth lies. The bond market gets it right a lot more often than the stock market does, as an example. The bond market's telling you in the United States that we are in a Japanese type situation. Not that any two cycles or any two experiences are ever 100% the same, but the bond market's telling you that we're going through a very similar post-credit housing bubble debt deleveraging cycle, and it's going to be deflationary.
So that's my next question for you, because you said that really that bond yields are determined by inflation. So while there are a number of people out there, and you've mentioned it too, the fact that the Fed has been has been easing so much and is basically expanded its balance sheet so much that it's going to end up being inflationary at some point, possibly. That's a risk, right? But is deflation really what's happening in the economy now, and therefore what does that mean for the bond market?
Here at home in the United States, there's two curves as an economist that you look at. You look at the aggregate demand curve, you look at the aggregate supply curve. You look at the difference between where the economy is operating today and where would the economy be operating if it was operating flat out at full employment. And that's what economists call the output gap. Everybody at the Fed knows what the output gap is. Any economist on Wall Street certainly knows what the output gap is. They love the difference between where the economy is and where it would be in nirvana, full employment. And
so where is it?
7% of GDP. Like, it's basically when you tack on the excess supply of everything, houses, labor, to a lesser extent capital goods, but certainly what is bigger than the labor market? You talk to a local baker, he's not going to talk to you about flour necessarily or talk to you about employee theft. He's going to talk to you about his biggest cost is still labor costs.
Right.
When you have you've got a situation where for every job opening in the United States right now, there's 7 people in the total ranks of the unemployed, of the available labor force vying for those jobs.
So labor costs are down, and are going to stay down or go lower possibly?
Well, supply and demand works in every market, and it works in the labor market, but it works glacially. We're not used to wage deflation outright. They never taught you that in university textbooks, but we are starting to see evidence of that. Because normally there's maybe 2 to 3 people out there looking for a job, vying for the job openings. Right now, that ratio in the year 3 of an expansion is 7 to 1.
Wow.
is unheard of. And that's like any other market, that's going to put downward pressure. But we have, when you talk about 7% of GDP, what does that mean? Okay, what does that mean? It means we have $1 trillion of excess supply in the economy. And how doesn't that drive a deflationary process over time? And that is exactly what the bond market's telling you right now.
So long-term bond bull, which you have been, and correctly so, do you still remain a bond bull, and what do you feel about treasuries?
Well, there is a possibility that treasury yields go lower, but at this point, you're talking maybe they go to 1.5% from 2%.
Right.
I think if we're looking at the overall fixed income market, I wouldn't mind stepping up the risk judiciously and buying corporates. Okay, because the one thing I will say, we discussed this earlier, when you're buying a corporate bond, you are staking a claim on the quality of the balance sheet in the corporate sector, and whether I look at debt equity ratios or interest coverage ratios or liquidity ratios or the whole gamut of ratios, the one thing I will say is that the quality of corporate balance sheets in North America are as good as they've been in the past 50 years.
And that's why you believe that corporate bonds, and North American corporate bonds specifically, right, are the one investment that we should all own some of on a long-term diversified portfolio at this point.
Yeah, and I don't think I would be going, adding a lot of duration, but I think that you can pick up a decent spread going out, say, roughly 3 years, 4 years. Yeah, I still like treasuries, but the love affair is over. But I wouldn't mind owning high-quality corporates that have a decent spread, that are mispriced for the economic outlook. And that's what I'd be focused on right now.
One of the things that you've told me at other times on an investment theme of yours is what you call SERP, which is look for safety and income at a reasonable price.
Right.
Still believe in SERP?
Absolutely. Corporate bonds would fall in that category. I think munis would fall in that category. So bond market in general doesn't mean I'm going to necessarily run out and buy Italian bonds right now. But because remember, safety and income at a reasonable price.
Right.
And I think that corporates, look, in some cases, corporate balance sheets are in better shape than some government balance sheets. But it would also include hybrids, premium income funds that might be equity, but they're equity that provide you with a monthly cash flow. So they could have REITs, and they could have preferreds, and they could have bonds, and you're talking about dividend growth, dividend yield. There's people that would say, well, that's a crowded trade. That's what people are talking about. It's being overly... But this is exactly what you want to have in your equity portfolio, is you want to be almost like a landlord. And hopefully the capital over time will grow, but you want the monthly cash flows. And so even an equity product can be derived that would be under the SERP umbrella that would be providing income at a reasonable price. And I think that's what we've got to be focused on right now. Remember, this is a stock market that has been doing this.
Right.
Very recently it's more doing that, but over the past several years, the stock market, in terms of capital appreciation, there hasn't been any for 12 years. Your total return's been the dividend. And I think that's going to continue for some time.
Final question, and that is, you're known as a bear. You just say, no, I'm a realist. But you're short-term bearish, but long-term you are actually could be bullish. So let's leave this on an optimistic note. Why are you long-term bullish?
Well, I think that for the same reasons that you would have been in, say, 1980. And back then we weren't fighting a deleveraging cycle. We were fighting an inflation cycle. That battle was different. It's not like the French with the Maginot Line. We're always fighting different battles.
Right.
But back then, we went through a decade of lost growth, and we went through tremendous volatility and weakness in the capital markets. But it was contingent on political change. And we think of, or most people, since everybody think of Ronald Reagan a certain way, that they didn't back in 1980. Mm-hmm. And of course he was unproven and untested beyond what he did in California. But when you go back to that period of 1980, if you would have superimposed that really terrible period from, call it 1966 to 1980, and everything that happened in between Vietnam and Iran and gas rationing and everything else, if you superimpose that period into the 80s and 90s, what a big mistake that would have been. But where did the change to the economy and the financial markets? What was the root? It was the change at the political level. And that's why if there's reason for hope, it's going to come from what the configuration looks like post-November 2012.
We'll see what happens. In the meantime, we will be following your work very closely at Gluskin Sheff. So, Dave Rosenberg, such a treat to have you here on WealthTrack. Thanks
again. Thank you.
At the conclusion of every Wealth Track, we give you one suggestion to help you build and protect your wealth over the long term. This week's action point picks up on a longtime theme of Dave Rosenberg's. It is to look for safety and income at a reasonable price. He calls it SERP. Two recent guests provided us with two different and not necessarily mutually exclusive strategies. For those of you who prefer to own individual stocks, great investor guest, ClearBridge Advisors Hirsch Cohen, shared his great balance sheets and dividend growers list of global brand name companies which Hirsch believes should be bought on weakness. We will have it for you on our website, WealthTrack.com. For those of you interested in diversifying into emerging market stocks, particularly in rapidly growing Asia, recent guest Robert Horrocks, Chief Investment Officer of Matthews Asia Capital Management, helps oversee the 5-star rated Matthews Asia Dividend Fund, which focuses on companies that grow their dividends. 2 choices for safety in income. Now, next week, we will have a rare interview with Wall Street's longtime #1 Washington analyst, financial thought leader Tom Gallagher. Understanding policy and politics has never been more critical to investors, and no one does it better than Tom. And on that note, we're going to conclude this edition of WealthTrack. For those of you interested in seeing our WealthTrack interviews early, subscribers can see our program 48 hours in advance on our website, along with timely interviews exclusive to WealthTrack web subscribers. This week, in celebration of Veterans Day, we are going to do a podcast with Kiplinger's Kim Langford about the things military families can do to build financial security. It will also be available on WealthTrack.com. Thank you for watching, and make the week ahead a profitable and a productive one.
Now, more than ever, you want to keep your loved ones safe and secure. We've been helping protect families with the gift of financial security for over 164 years. New York Life, the company you keep.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.